Get 50% off the first month of SpotGamma Alpha with the special promo code. The link is in the description.
Hey, greetings all, and thank you so much for joining us. Macro to Micro Options Power Hour. And we're very, very happy to be joined by a featured guest who is actually a longtime friend of markets and also of LaDucTrading. We're very, very happy to welcome Brent Kochuba, founder of SpotGamma, whose tools we use every day with our clients. So our contributor desk is just full on focused on what their tools have for spying option flow and interpretation thereof. And then we educate clients using their tools. So it's a really great time to have Brent in and give us some good views of where he sees market optionality moving, because we have basically been in a very wide sideways swath of volatility for a few weeks now, and I think that's going to continue until we can compress down. But after some wild ride lower since our last webinar, actually, Brent, in January, where we were at 6,100, and I said, but we just need to break this and roll over, and there are a whole bunch of levels to hit on the way down. We did go and tag this 48.78 that I had, and we have basically been bouncing around that 52.50. We had some headlines come in yesterday, which absolutely gave a little bounce to the dollar, to bonds, pulled back the yen, and definitely spiked equities. And it's a combination of peace headlines with Trump all of a sudden playing nice in the sandbox with Powell, which is very structurally powerful for confidence. And our market is all about capital flows and confidence. So now that we've also had some war vibes, kind of de-escalation as it relates to Putin and Trump also picking a date to kind of talk. And then, of course, Bessent is out, Treasury Secretary Bessent, doing his economic speech, and more discussion around potential de-escalation on the China trade war front. Now, I've got lots of opinions about all of that, but the point is, it definitely helped to bid up bonds, soften that gold parabola, and put a bid in equities. So that I'm going to throw it over to both you and Hans, our partner in crime over here, Hans Albrecht. He's our options mentor extraordinaire in our LaDuc Slack member workspace. So, and he is just into your tools as well. So we all have lots of familiarity with them. But what we really want to hear is your kind of market views, also your new tools that you've just launched in early April, which is more aggregate dealer positioning. Love that one. Hit it. Tell us what you're looking at and what you're sharing for market direction next.
Thank you, Samantha, and thank you all for having me here. I really appreciate it. And just to jump right in, you did indeed. I remember that conversation vividly about those market highs in January. So kudos to you. The last couple of months have been interesting because most of what we talk about at SpotGamma is historically the idea of dealer gamma buy strike, and where does that sort of bring support and resistance and invoke volatility of the markets. And when you get into these situations where vol is breaking out and there's potential credit market issues and there's this real macro flows abound, that gamma by strike paradigm goes away, and you really have to look at volatility and options prices as kind of the source of truth. And to give an example of that, there's all these headlines, like you said, we've had these wide ranges, and there's headlines and there's conjecture and rhetoric, and there's very little to actually grab onto, and there's so many different dynamics, as you know now, that it can be hard to assess what the impact is, right? Because kind of what you mentioned, that there's the news and there's the reaction to the news, and the reaction is oftentimes the truth, is the market is the voting mechanism. So we've been really focused on looking at implied volatility from that perspective. And just to give you an idea, the market today was up, well, at the highs 2.5%, 3%. And if you looked at the change in volatility, like S&P vol, it did not budge at all. And so if you figure that, hey, a China trade deal's coming, Bessent is talking this down, or there's war situation, whatever your belief is, if the market was sniffing that out and believing that that was true and real, you would think that traders would anticipate less volatility in the future, right? And we didn't see that at all. And so you have the situation now where the market's extremely illiquid. There are still gamma flows in terms of negative gamma, which means that if there's short covering, then there's still dealer flows that have to chase the market in either direction. So that exacerbates volatility. And so I think what happens in these situations, you get a 2% rally on a headline, you go, this is the dip that we've been waiting for. The bottom is in, like, here we go. And when you watch vol doesn't budge. And that is your signal that what has just happened is just a reflexive flow and not actually an adjustment to kind of risk expectations, if that makes sense. And that watching those vols has really been able to help us navigate, I think, things a little much cleaner fashion, because it's very easy to get emotional here. It's very easy to kind of like chase things in this environment. And also it's hard to figure out what's real and what's not real. And so
that's a good way of putting it.
Yeah, watching, watching that vol has been very helpful. And I think, you're piecing together those macro pieces so neatly. And I think I kind of like dumb it down a lot by just saying like, just tell me what implied vol is doing and I'll try to like guess from there.
No, you're laser focused on the volatility. So is Hans, and can interpret that best for our clients as well. I am focused on, when you talked about the extreme illiquid markets, I look at when buyers step in, when they step away. And so that's basically underpinning whatever market direction call that I make. So they really started to step in. It only started December 2nd. They really started to step away and sell on February 19th, before the Friday, the 21st, where we had the big drop, and before December 18th, 3% drawdown. So I started to see selling underneath the surface. Now we're to a point where really they're afraid to step in. So we have a lot of work to kind of repair, and capital flows. I have that mantra, right? Money goes home. They really have started this exodus at the beginning of the year, and it's only been pulled forward, where we have risk of this tariff war and recession risk, and everything's been pulled forward very, very aggressively. So there really hasn't been certainty. And one of the reasons why gold has done so well is because it loves an uncertain backdrop. But your point about illiquid markets is really core. We need capital flows and we need confidence. And right now we still do not have either, even though they're coming out on a regular basis, oh my goodness, daily, trying to placate. And not just the volatility is elevated, but the yields are elevated. So both of those things are part and parcel for any tailwind moving higher, is for volatility to kind of create a lower regime below that 30 and stay below 30. And Hans and I have talked about this every single Wednesday. It's a new regime, not just political regime, right, monetary regime, but also volatility regime. So yes. In your tools, when do you see volatility dropping and staying below 30? Because every bull wants to know.
Yeah, and the VIX now adds a lot of noise, and you have this very steep skew in the S&P options prices right now, and that when you look at 1 month options, which is what 1 month S&P options, that's what the VIX is priced on. Because skew is so steep, the VIX price will jump rapidly up and down, because it's sliding up and down this very steep skew curve. And so you can get a lot of noise, or you can oftentimes think like today, VIX is down 20% or whatever it is. And then you look at under the hood at the actual fixed strike vols in the S&P, and you see there's not a lot of movement there. And so in this environment, to get, let's just say at the money S&P vol down, or like the VIX down towards 20, you need a deal signed, you need a pen to paper, something that we can all grab onto and say, this is truth, this is verifiable. And even if it's a bad deal, right, and it works against us, then the market could start to price that in. But right now you can't price anything in. There's no, what do you do? And my question about this was like, from my perspective, if vol goes high enough and I can start to say, okay, the risk premium here is really rich. I feel like I have some trading opportunities there. If there's a big pocket of short put positions in the S&P, then that's an area where I think the dealer flows could be supportive of the market. I don't see that till 4,800. That's a number we've been harping on for the last couple of weeks. We sniffed it, in early April, but that's still the level. Nothing's changed there. So even like PEs or fundamentals aren't good. So like, what brings an incremental buyer into this market right now? VIX is not overbought, quote unquote, at current levels, because realized vol is at 25 to 30 or even higher, depending on exactly what your time frame is. So, if S&P realized vol is at like, let's say 35 and the VIX is at 30, well, that's telling you that actually implied vol is maybe a little bit too cheap here, right? There's no vol premium, so I don't want to buy off of that. There's no, like if Apple's trading at a 5 forward PE, then maybe I'll just buy it and like just duck and cover for a year or something like that. If there's a deal that I could latch onto, then great. But like, where's the value in any kind of discipline at the moment? I can't find it. I'd love to know if where.
Are you talking from a macro standpoint? Because Hans can definitely talk on the VIX front. He actively trades that. But as it relates to kind of
across the board, yeah. Give me any signal you got. Like, give me something something to believe in.
Yeah, I guess that's what Brent's talking about. Like, what can you hang your hat on, right? We look at PEs, great. Well, what's the E? We don't know what the E is. We don't even know where we're going to be tomorrow. We don't know if they're going to say something different from morning to afternoon. So we're just completely upside down right now. So Brent's sort of wondering, well, what sort of compelled real buyers to start coming back in? I don't know about all this foreign money that's basically gone east for how long now. Does that start to come back at some point? Because I feel like that's got to sort of maybe come back a little bit too. But what really gets people excited about stocks at these levels?
Honestly, a confidence. No. This is easy. This is really, we are all about capital flows and confidence. Earnings are ratcheting lower Q1 to Q2. There's no question we're not even done ratcheting lower in earnings. So this is not going to protect bulls, right? It's very much focused on short term, like you said, the dealers chasing. We also have some CTA positioning, which is back at the 2020 lows, and certainly they can come back in and force some rotations, right, out of stocks into bonds, out of gold into equities. But big picture, capital flows coming back in the US, I think that's done. They're leaving, and there's a reason for that. The administration wants to devalue the dollar, and the devaluation of the falling demand of dollars is ultimately to help US exporters. That's the short-term pain for the long-term gain. Now, the double speak, in other words, or out both sides of their mouth in regards to getting what they want with lower energy prices and yields and dollar. Well, they've got 2 out of 3. They removed kind of the intervention collar as it related to energy price, which was one of the things that they wanted. They wanted to dump the price of crude, which will later serve as a potential stimulus. But for right now, it's also shaking and making the oil and gas industry very nervous. Falling global oil demand, falling global credit demand. This is what's also freezing the market. You saw the bond market absolutely go haywire on April 8th, which is why when our US 10-year jumped to 4.5 and our 30-year jumped to 5%, and that was all based on really some serious selling. They came in and again talked the market down, but it's already, the damage has been done. The tariffs and the trade war communication drama we didn't need. If they would just shut up, we'd be fine. So the fact is, the only way that it's going to reverse, and I've got lots of data that we're not done on the earnings ratcheting lower and on the dollar falling and on yields rising, and basically currency is now conducted outside of, in other words, trade is being conducted outside of the US dollar. They're settling in gold. They're settling amongst themselves. It's outside of the petrodollar. These are big regime changes. So long story short, it's not good for equities. The only thing that would turn this ship around short term would be a Powell capitulation, and longer term would be Trump coming out saying, I was just kidding. And not just saying, oh, I'm going to delay him, until July 4th or, the 90-day thing that he did, but really saying, you know what? I think we got a good system as it is. We're going to go back to, but he's not doing that. And his ego won't let him. And they still think that they've got China on the ropes. So there's way too much hubris and way too much miscalculation. And a lot of people were very bullish on, Trump's plan to do this wealth transfer from Wall Street to Main Street, but it's hurting small, medium businesses in an outsized way. If he comes in and says, okay, Apple, on April 9th, we're going to push that tariff away on China for you. But everything that is assembled, sourced from China and comes into the US by small, medium businesses, you still have 145%.
Right.
So no one's going to trust the US.
It kind of reminds me of
COVID.
It reminds me of COVID. Remember, like Home Depot could stay open, but like mom and pop down the street were like, nope.
Bingo. And
that's right. And
Besant out talking, in a private wealth equity meeting yesterday, JP Morgan, closed door. And then, of course, it's whatever. It's a confidence crisis. And until that gets resolved, the equity market is still going to be short the rip. But what do you see? Both of you, because Hans is on this. Oh, my goodness. Looking at the intermarket. I'm looking at sector rotation. I'm looking at macro. And then I can do my technical analysis on stocks and, sectors and markets. But you guys are digging into the option market, and you've got some toolkit, obviously, Brent, that we want to kind of take a look at. But do either share your overarching views right now. What do we see first, 6,000 or 4,000? I mean, where are we going next before, in the next few weeks, probably not very far because we've got earnings and we kind of get frozen. But big picture, take your turns. Where are we going?
Yeah, Hans, I'll let you handle that one.
Well, I mean, that's a tricky one. If there's one thing I've learned having done this for so long, it's that you can never underestimate the market's ability to climb that wall of worry. Even though this wall seems incredibly, incredibly high, as you were alluding to earlier, Samantha, we've got these CTAs, many of these systematic strategies, vol targeting in particular, almost completely, out of the market. And if we look at some of these potential flows, they're buyers in a down market, in an unchanged market, in an up market. For now, we do have some of these things. And this speaks to the things that Brent does, is that this is a kind of a whole new world where you and I always talk about, the dog and the tail and our derivatives, our options. The dog now, well, they very well could be. And that's why this is so important. So I was a market maker many years ago. And what we did was sort of inconsequential to the equity markets, right? Like, it's funny because everybody's talking about gamma and charm and VAN, all these things. I didn't even know what some of those things were called when I started. I was like, oh, I don't know. I understand that if I own calls, I'm going to get crushed because the vol's coming down. Oh, okay, that's VANA. Oh, now I know. So this has become part of the parlance for traders, and I think it really is important. And Brent talked earlier about fixed strike. And so when you and I were talking about when things started to come down, Samantha, we were bearish and we sort of targeted that 5,500 level. And I don't know if you probably remember this, Brent, but there were a few days there where we dropped a little bit more around that kind of 5,600 level, yet fixed strike was coming down. The VIX was not reacting to that. And so I think that's an example of these little nuanced things in the volatility space that speak to these tools that you can use now that give you that little bit of extra tell as to what's going on. Because really, broadly speaking, when people talk about vol, basically at the money vol, what's at the money vol doing? Well, there's a whole bunch more to it. And when you start to look outside of that very, kind of popular at the money volatility level, you start to see other things happening underneath the surface, and they can kind of give you an idea of where the fear actually is. And so that's where we were talking about, well, we're going to rally 150 or 200 points. Sure enough, that did. Now, does that mean, is that necessarily a longer term kind of thing? Does that help you if you're an investor? It certainly, as a trader, I think that can help you. So I love all those things, and that's why we talk about these things. That's why we discuss them with our members, because they are very, very useful. Just look a little outside of the normal realm of what you look at, and you can actually start to gather some very interesting information. So to your point about, where are things going, I think we could move up a little bit into that sort of 5,500, 5,600. I think that's where I'd probably be, probably starting to get a little bit short, add some hedges, sell some call spreads, things like that. Maybe definitely collar some positions in portfolios, which I'm already doing. So yeah, I think we can kind of get up in there. Beyond that, I find it hard to believe that we're going to get too far beyond that, just based on sort of valuation, simply put.
How do you have your SpotGamma kind of aggregate dealer positioning right now? What's that look like, Brent?
Yeah, if you look at, if it's cool, I can share my screen. I can just talk through that.
Yeah, sorry.
Quickly. No problem at all. That 5,400 to 5,500 range is the range that we were talking about for the upside. In that, if you actually had a deal, right, like we signed a deal with Japan or Vietnam, or like anything, then you suddenly have to go, okay, vol's actually going to come down because people are seeing the deals come in, and then you have to like kind of reduce this expectation of there being kind of like a ceiling. But if you just look at the positioning, and thanks for letting me show this quickly, if you come in, and this is what the new dealer positioning is showing us, that I'm going to show you spiders, which is, here's SPX, right? And if you see a positive bar on this chart, that is a dealer positive gamma position. So the dealer positive gamma positions we talk about is 4,800 down to really 4,500, this whole area. This is where there's like possibly enough dealer gamma, positive gamma, that they would start buying that dip. And you would have to think that vol gets the vol premium gets pretty rich in that area. And then you also say, well, from a sentiment perspective, those are very big positions. And so there has to be some funds down there that are saying this is value for us in the 4,800 area. You're generally not going to sell a put if you think it's going to get significantly traded through, right? So that's the very clear downside area. And then when you get up into 5,400 and above, you start to see the positive gamma strikes, which is driven by call selling, start to pick up a little bit, right? So it's not huge, but it's just general area. So this big one right here is 5,500. Well, if you look at the S&P high today, we got up to 55 or 5470, right? We started to sniff that area, but you see that reaction come in where selling calls in this environment to me makes so much sense because we don't actually have a deal. Vol is still very high. We rallied 2% overnight on a tweet. You know, what does Trump tend to do? He tends to walk back whatever he just said about 5 minutes ago. And so, you know, that's a great way to get short the market, but also if the deal is real, then you would think that VIX and the vol comes in. And if vol comes in, then you would think that out of the money calls would also kind of get crushed, right? To what Hans said earlier. And so that tends to make, you know, a lot of sense to me. The other thing that's interesting is if you just look at spider positioning, and again, we take this data from the exchanges and we add in some new modeling. And so we've never before been able to show people, hey, this is precisely where we see market makers as long and short options. You can see these are negative gamma bars in the S&P 500, right? It's negative really across the board all the way up until about 550, 560. This curve starts to flatten out. So what is this big negative curve meaning? That means right here, SPY 545 all the way down to 500 is just massive spider negative gamma. What does that mean? That means that this zone of 5,500 to 5,550 where we traded today is like 5,000 to 5,500, right? That 500 point range. It's just all negative gamma, right? It's no coincidence then when you look at what the prevailing range has been over the last month, you just see we've just been ripping through that level back and forth like a ping pong ball. And the problem is that you assign a narrative to why we are doing that. I mean, this is the range here, right? So dealer positioning has not changed at all. This is 5,500 down to 5,000. Really, we're just flinging back and forth between this range because there's no liquidity and we're just reacting to tweets, right? No actual, nothing concrete. So I think just to project forward, I think what we're seeing here is 2022 where we just grind lower all year. The VIX probably put its high in. And the only reason that I think that the VIX would go higher is if the credit market breaks down. Because if you look at historical VIX, true VIX spikes, 40, 50, it corresponds to credit market issues. And that is because if you are in bonds, right, and you are worried those bonds are going to go to zero, then you buy equity puts because that's the way that you hedge your bonds, right? Because equities go to zero before bonds do. And so, that's the primary driver. And they're generally going to be more price insensitive versus like an equity vol trader, right? And so I think this looks a lot like 2022. We just grind down. And then when do we stop grinding down? Well, like probably when Powell's like, I'm going to cut rates. And it's kind of like 2022 is like, when are we going to stop grinding down? Well, I'm no longer going to raise rates, which is sort of not exactly the same thing, but echoes it, right? Basically you get the Fed put kicks in, I guess.
So kind of a higher vol regime where, do you think VIX 30 is the new 20 kind of thing? Or can we get down into the low 20s? Is that possible?
I mean, this is 2022, right here. And we were 20 to 30 was the average value in VIX and vol. And why should we expect that to really change right now? Okay, maybe if we sign 10 deals at once and everything turns around real quick, then maybe that paradigm shifts. But they just said it's going to take 3 years to get a China deal. So I don't know. And the other thing that's interesting to me, and this plays back into really what Samantha's specialty is in terms of, the macro to micro, if you look at equity correlation, right? So correlation measures how in sync individual components of the S&P 500 are. So like there's NVIDIA, Apple, Tesla, et cetera. Do they all trade with the S&P or against it? The most bullish market we've had was this semi-AI chase, semi-stock AI chase in July of last year, right? Where, NVIDIA was going up 20% a day and correlation hit the lowest it ever has, which means that people were betting on individual stocks, right? Like it's guaranteed that I need to be long equities, but I need to be long more of NVIDIA because that's going to outpace the equity market, right? That is not the environment right now. The environment is, do I own equities at all, or do I own cash or Bitcoin or whatever, right? And so correlation is now up to 30, and that's a huge spike from last year. But look at where we were in 2001 and 2022. Like we've just sort of like moved back to that environment where the macro is so much more of a driver here. And I think everyone says that, but there's no reason for everything to go back to where it was in 2023 and 2024 right now, right? If we get trade deals done and they cut rates and we get, Donald Trump tweeting about the daily Dow price or whatever, then okay, that's a different regime to your point again. But right now we've kind of just normalized, and why should any of this stop? I just don't see any reason for it to end.
Let me just show it up because you've mentioned two things that I want to jump on, and then Hans, take it. I just wanted to get these fresh while he is talking about it. Okay, so this is that growth value rotation chart that I'm always on, among others. But the point is, when you were talking right now about that big NVIDIA push from July until the the top, which was about July 19th, actually, it was basically May, June, and July, that yellow arrow. Hopefully you can see it. That is when actually Craig and I were doing a Wednesday market macro to micro, and it was focused on, I'm pretty sure it was July 19th. Anyway, it was all about the yen carry trade unwind coming in. So basically, this is literally the top when we came crashing down into that August 5th convexity low, right? But it took weeks before it was safe again and the market was able to really get going. So basically, we started rolling over beginning of the year, this concentration risk unwind. I'm trying to talk over my phone in the background. Once I turn the ringer off, I never turn the bloody ringer on. Anyway, we have been coming down. We're in bear market territory, full stop. So what I'm trying to say is we're still down here slogging it out. March and April, it is not safe until we get back above this zero line. Hopefully that makes some sense. And the only way I'm bullish, and I keep going over this with clients as well, is if we can kind of pull out a potential, left shoulder head, that looks like a terrible color to use.
I got it. Yeah.
If we can come back up and trigger above this 2 ratio, if we can get back above this 0, then fine. We're going to have a beautiful growth rotation. We're probably going to have, an easy time of getting back to that 6,100. But until then, no. And to answer the other question, which was related to credit spreads, this is one of my bets early, and I kept saying it. This is NASDAQ composite on a weekly, and this is high yield spreads down below. You can see where basically during COVID, we had this nice long trending, nobody was worried about credit spreads, and then all of a sudden they blew out, right? Now, we had the same type of very, very long descending tightening of credit spreads, and now we are above that trend line. Now, doesn't mean we can't come back down, tighten up, which by the way, they're trying to stabilize the past few weeks, right? But also not moving. So it was very, very dangerous. Now, you can also see what's happened with NASDAQ composite. We came back down into a perfect tag of the 200-day. The point is, this is still not out of the woods.
Right.
So when you talk about a credit event, I am on this. In fact, this was one of the things I said early because I've been tracking this every single week. I look at these charts, right? So this is where I said, no one's expecting credit spreads to widen or the yen carry trade to move higher. I am. So that's still in play. That's not resolved.
Yeah,
Right,
there's some problems below the surface, right, Brent? I mean, if you look at the VIX futures curve, it's not telling you that it's in a state of happiness at this point, right? So that hasn't really unwound. So there's some durable signs out there. Would you agree?
Yeah, 100%. And that keeps the bid to vol, and it's also there's nothing like an options expiration that's particularly close or whatever. You have to go to like June to be like such a significant options expiration that maybe we could kind of like turn. At this point, again, it just comes back to like what brings in the incremental buyer. And I think, with hindsight, you can look back at the December market, January market, and be like, that was very overbought. People were really complaining about breadth and everything else, and P's were super high. So this has just been a mild correction, and, arguably from overbought territory. I know I say with hindsight, I definitely didn't short the market with every dollar I had at 6,100. I wish I did. But point is that you could argue that so far we've only had just a bit of a normalization of the market. There's not actually been pricing in any type of damage that has potentially been done from whatever policies are taking shape. And quite frankly, they seem very comfortable with taking the equity market down. Like I can't ever remember, and this was a month ago now, where the president's like, the economy is going to hit some skid bumps, right? And when has a politician kind of ever said that? And you think back to that now, you're like, well, that was no duh. Clearly shorted this thing. I think that the point is like everyone anchors to the previous prices based on the idea that we have the same regime, right? And it's a different regime now. So why should we expect the same market highs that we had coming in unless something materially changes? And you just don't see it. And in the options market, you don't see these buyers coming in. You see people willing to sell some puts into lower prices a little bit, particularly in single stocks, but there's not this idea of, hey, like time to buy all these longer dated calls, and that's the sign that this bottom is in. You kind of just see reactionary short dated trading. And again, with no concrete deal in place, like what are you supposed to do here?
Can I ask you, do you focus at all on these types of duration? I mean, CTA type of positioning, right? Like this just came out, and you can see CTAs are, first and foremost, let me just show this chart. Systematic positioning is pretty pretty much in the kind of 2020
Yeah.
low. Doesn't mean it's done. I mean, we obviously had to base a while in 2022, and then we had to get central bank intervention come in October of 2022, $1.5 trillion in global central bank liquidity to get the bond and the equity market bid up again. That's Matt King, by the way, of Citibank. But the point is, we're right down here, I think, for a reason. So I don't see this, and they were talking about this as well up here, right? When, buy the dip. I'm like, no. And wait until it bases and then gives you some reason to move higher. But do you follow the CTA kind of market scenario where Hans was alluding to it earlier, where, for example, in the next month, they're buyers in basically any situation.
Yeah.
But I have to also caution, they're buyers of 48 billion. But hold on, I want to make sure I got the right kind of, thing here. They're buyers of 48 billion, but only 8.63 billion is going to go in the US. See?
Yeah, that's funny. I saw the headline too of the buyers of all scenario thing. And, my problem with this is that whether or not the CTA flows are like an actual trading signal, I personally have not found, and I'm not saying that you can't find it. It's like it's never jumped out as me as obvious. But the thing that I think is interesting in this environment is that all of these flows have to be changing so dramatically because of the way that all these assets are shifting. And then you look at like margin rates and, short, rates and all these other things. I don't know that those flows are working in the same method that they did two months ago, or even necessarily 2 weeks ago. So that's one of the things that I have here. And then, it also goes back to the idea of like, we always watch Gamma by strike, and we had to tell everybody, it was like this mea culpa, like we're going to stop talking about that right now, because in this environment, it doesn't matter. That flow is not going to matter like it historically does, because the political landscape and everything is changing so drastically to the point of people repatriating dollars out of the United States. Or I can't tell you if that's true or not.
Bingo. Oh, no, I can. That's exactly what I follow. No, that's 100% my focus is where is the money flowing and who is doing the buying, the selling, and what's going on right now. And you can already see major developed economies, right? You got a euro that's up 11% year to date. You've got the Swiss franc up 12%. They don't even show the Polish. The point is the money, it's gone home. And more importantly, it's also staying home. And then it's transacting trade and related amongst themselves or settling in gold. So this is really a situation where you're right. The CTA flows and the like don't have the same power that they used to. By the way, this is a data trek chart in case you're curious, the source. Now, what about your dealer positioning? Before I ask you that, real quick, can I show you something?
Yeah, please.
As you said, you were talking about volatility. All right, so let's just see if you can see this. I have a very different thesis on volatility, Brent. I don't think it's done. So at the beginning of the year where everyone was,
Meaning you don't think new highs? I mean, you think new highs are coming?
Yes, I do.
Okay.
So at the beginning of the year, when everyone has these, huge outsized 6,500, 7,000 SPX, I'm like, no 7,500 hat for me was the title of my client post. And I do these intermarket reviews, which you say macro is my thing. It's really intermarket. I use macro as a backdrop for the trigger for the event risk. This is my thing. But I said volatility, 2025 is going to be the year of volatility. And this is a funky little chart and it's ugly as could be, but it's my personal favorite. And you all have to have a language in which you can interpret the market. You got yours, Hans has his. These intermarket relationships are huge to me, cross-asset analysis. This is, back in the 2000, that's VIX underneath, by the way, just to kind of show you. And this indicator that I'm using right here is a stock bond ratio. Now, if you kind of notice from the great financial crisis, as this is moving lower, the market's moving higher, right? But it has a point where it starts to go sideways and this blue line starts to flatten out. And then, by the way, we get QE and the, market goes up and this ratio falls and then we go sideways. This happened to be, repo and 2019, there was a little, drama there. And then we get into this, that was 2019, sorry. That was the oil industry recession. Then we had COVID and you know what happened with VIX, it's way the heck up here. And then recently we had August 5th convexity rally where VIX hit 65. It doesn't even show up here, but the VIX 60 does. But look at how this is still moving up. Like this has not even flattened out. So I think that this is not done. I think we're going to have waves of volatility. And this is one of the funky things that I use to kind of track when we have a regime of falling volatility. And that's an intermarket tell that I use. And I know I'm looking at the big picture monthly, but I do it on a weekly. I do it on a daily. Heck, I even do it intraday now. I'm so fascinated. But the point is, I don't think this volatility is done this year. at all?
Yeah, I mean, I certainly don't
We don't
disagree
know.
that.
We don't know.
Yeah, I don't disagree with the volatility. I don't think it's going away, but the higher highs we'll see. And so much of what drives that volatility is that real lack of liquidity, right? And so,
Yeah.
certainly any more shifting around in the credit markets and playing there just dries up that equity bid, right? So those spreads widen out, what's available on the bid and offer go away. And not only did that happen, we had record equity volume and record options volume at that same time that liquidity just disappeared. And the result is these 400 or 500 handle moves that you get up and down in the matter of 7-8 minutes, stuff that I've never seen in my career. And that is just so indicative of just a very, very, very unhealthy and kind of like sick market. And you look at today, up 2.5% and back down another percent. Like these are things that you go back in time and you think over my 20-year career, it's like, I can't recall seeing this kind of stuff before, and it doesn't, bode too well. The other thing that is interesting to me, and I like your point on this, is like, gold has been moving up so strongly. I think for most people here, you think like that is not ultimately a very healthy sign. For the first time since the rally started, just in the last couple of days, we saw gold implied vols get to a level that we're like, okay, this is now showing as overbought. That condition went away in like 2 days. Like it really kind of wore off pretty quickly. And then the other thing that is kind of shocking to me, and a lot of like Bitcoin people will be like, well, no duh, Brent. But it was like Bitcoin vol was the lowest of all assets that we track over the last month. And if you're going to tell me that the global financial system was going to start getting rocked and Bitcoin vol was going to be like the safe haven, like I'd probably be like, this is crazy. But that's kind of what came out of the last month, where that has been really quite stable. And someone had posted a tweet that was basically saying like, this is such an interesting moment for Bitcoin because it is this capital flow asset now, but it's also a risk on asset where I think we all know if QE comes out, then that crypto market starts to percolate again. So it's like, is it a win-win situation for Bitcoin, which we haven't talked about that at all, but Bitcoin vol finally started to get bid here yesterday and today. And so, it's interesting.
It's funny that you mentioned this because Archana is in chat mentioning this. As you know, she's my live trading room moderator, one of them. And she, a few weeks ago, had said from your scanner, right? Because they're tracking this stuff. She saw coin and MSTR. And so we size it up technically saying, yep, it's coming up. And I know you love MSTR and Hood as well. But the point is these Bitcoin proxies, they can be liquidity tells. They also can be inflation absorbers as it relates to Bitcoin. But as it relates to gold, this is actually the chart that I showed clients. And this is important because, and I mentioned this, if I can get my duck here where's 6? Here it is. Okay. This is something that I showed clients as it related to, okay, this gold run, this is another ratio, and it's basically gold relative to the S&P. And I was waiting for it, another little inverse head and shoulder down here. Anyway, I was waiting for it to come up here where it has digested quite strongly in the past. And then wouldn't you know, Archana's in the trading room. I showed this on Monday. I showed it on Tuesday. We hit almost 3,500. It was like 34.99. And she's like, I'm shorting it. But she was also long MSTR. She does your combo with my kind of stuff and puts it all together. But the point is, this is also a little bit of that gold rotation back into Bitcoin. So they are right now, they are capital flows as well. I'm wherever the money flows,
Sure.
This is where I try to follow. But the point is, gold is still a much, much better positioning tool in a macro backdrop of uncertainty. Bitcoin is a speculative inflation absorber, and it may or may not work. And especially right now with everyone very excited about, money supply and dollar falling, they think that Bitcoin's going to save them. I did a big, long client piece this weekend going, be careful what you ask for from Bitcoin. As the dollar falls, so too will Bitcoin. So long story short, gold is still the macro safety trade for all kinds of reasons. And I think Bitcoin is much more speculative. Trade, not trend. Gold is trend.
That I can appreciate. I still feel like if there's big deflationary kind of impulse that Bitcoin maybe gets liquidated a lot because a lot of retail investment. But the other thing that's really helped us to the point on vols is that it's hard in this environment to figure out, hey, is this overbought or does this have a lot more room? And you track it very well on the technicals. But when you watch the options prices, you'll start to hit a point where the bid to options prices will get so expensive. Calls get so rich or puts get so rich that they can't sustain the move. That's kind of what the options market starts to tell you. And that is oftentimes a very effective, high to the point that, Archie, we're flagging like gold finally, vol got very high. It was a
Yes.
very similar thing back when the Chinese stocks like BABA and those were rallying earlier this year, and even Bitcoin being arguably a little bit too cheap. And it works, I think, the same way to the downside in the equity market, where you'll see put prices will get so expensive when the market's crashing that you can't sustain that pace of downside anymore. Like the rate of change can't continue to go lower. Options buyers are generally not stupid people. They'll start to back off in that environment. Oftentimes that can also be a sign of forced buying or selling, right? Which obviously tends to coincide with moves topping out or bottoming out, right? And so I think there's just a lot of truth in that pricing, and that obviously syncs with the way that things show up in the technicals as well. So it's a nice.
That happened in gold, right? We saw that in gold, exactly. We talked about that last week, Samantha. I think
did.
you asked me, and I said this looks exhaustion, right? This is an exhaustion kind of sign, that upside call skew just really, really blowing out. People short, scrambling to do anything they can to protect that upside. That's usually the sign. And as Brent was just talking about, we saw that in MSTR. Remember when it got up to 550, that call skew just went bananas to the upside. So those are always, and you've seen me talk about that many times, Samantha. So again, that's sort of one of those little nuanced things that I try to teach members and anybody I work with, is to look for those little signs there of exhaustion. It doesn't always mean exhaustion. If it happens as a move is beginning, it can show that there's something building there. So you kind of have to, it's a little bit of art and science, but definitely we saw that in gold recently. And it did make another little move up, but then we got the collapse.
Brent, you're getting a question asked, why not sell the puts below the levels you just stated, which offers higher premium than selling calls? And can you show the calls and put gamma, which really shows how much calls are being sold along with puts being bought?
Yes. So generally speaking, if vol is going to come down, right, the market is generally going to go up, and that's typically how this works, right? And it's about the rate of change in prices. And so if you watch in this market in particular, vol changes very quickly, particularly in short dated options. So what we have been talking about is, look, if the market is going to start to rally because a deal is made or it looks like a deal is going to be made, then volatility should start to come down over time, right? Over the next 1 to 2 weeks, right? Okay, we signed a deal. Risk is now lower today than it was yesterday, and that's a good thing. And so you're going to get that knee-jerk rally of 2, 3, 4, 5%, or in the case of what we saw recently, it was like 800 handles right in 7 minutes. And so that short-term reaction, vol is still going to be very elevated in the teeth of that move because there's still volatility. It's just expressing the upside. So if you're in front of your screen and you can sell calls into that type of a move where that energy is so high, you're going to sell at very, very rich prices. And then the minute that the market calms down and starts to plateau, then those call prices should really come in rather sharply. The problem with selling a put in that environment is, look, if Trump signs deals, then we know for a fact like it's real and vol is going to come down over the long term, then that can be a good strategy. But you're going to sell puts while the market's going up. That doesn't make a lot of sense, right? Because puts are going to be losing value from what we call a delta perspective because the market is going up, right? So you want to sell arguably into the move if you can catch the highest amount of energy in that situation. I'm also of the view that we will get 1 or 2 huge rallies when this is done, and then the pace of change starts to level off. Why? Because typically what people do is they're long stock and they sell calls as an overriding strategy. And that, I think that comes back in as a big flow once we get into 56 or 5700, like under a true rally. So some of it is you sell a put into a market that's not stable, you're going to regret selling that put if the move unwinds. And how many times have we seen the move unwind? A million times. So if you believe that ultimately this ends with the market starting to rally and just vol coming down, then I'm happy to be short very, very expensive calls with the hope that the market just stabilizes. It's not necessarily a bet that I think the market's going to crash back down. It's a bet that I think vol starts to contract. So that's why I focus on selling those calls into that upside. If the market crashes to 4,800 and the VIX goes over 60, then I'm going to want to look at possibly selling puts in that scenario because the risk premium to the downside gets so expanded. So, you really got to use that directional move to hopefully help, harvest a little bit of extra premium.
Hans, what do you see next? We're getting a question. Do we go high before we go low or low before we go high? I'll tell you my answer. It's if then.
Yeah, if then.
What's the next headline?
Well, I think Trump has shown his hand. He's doing the flinch, right? We've seen 4 or 5 flinches now over the last few weeks. So that's really taken a lot of the sort of existential risk out of the market. So as Brent said, I kind of agree. Maybe we've sort of seen the high. We may have not seen the low necessarily. We could definitely tag that 4,800, 4,900 level again. I think that's what's going to make this market kind of fun, is that we're going to have some movement in here. So I think we can probably sell off. I thought we might touch 5,000 recently, but of course we bounced here a little bit. And I think it remains a trader's market. I think, like I bought leaps a week and a half ago and I'm selling them out, which sort of makes me feel silly. I'm selling out things that I was like, oh, I'm going to hold on to these for a while, but you're being given these really nice returns very quickly. And I think you accept it for what it is, right? You take those 50, 60, 70% quick returns in a market like this. I think this is not a paint dry kind of market. So your torque is vega, it's movement, it's delta, it's gamma, it's not theta, right? Theta's not really coming into playing into this. So you're playing the movement. And I think we just continue to do that. I think we may see just a little bit of a bid in here. We've seen such incredible bearishness, the AAII, we've seen levels of bearishness that we haven't seen in a very long time. That ATR, those S&P daily ranges that were as big as we've seen since the global financial crisis. So I think we've seen some things that were extreme levels of fear. And I think there's still a little bit of room for that to kind of seep out just a little bit, given the number of flinches that we've seen.
I would just add that the range of what is scary now is the end of the financial system in some ways. And so I think, like, to the point of regime change, it's like if you look at what the possibilities are now, we are like, well, the possibility is like the abyss, or it's like the best thing that's ever happened. So like the range of outcomes now has definitely really widened out.
Place your bets.
Yeah, you can write a scenario for really anything. On the topic of correlation, to the point of if then, right, there was a couple of tech earnings, like VRT was one where it was up 20% this morning. You're going to get a lot of earnings this week. Yeah, Google and Poly just reported, and Boeing reported, and all these companies. And from my naive take, it didn't seem like, hey, the tariffs have totally and completely screwed us over here and we're like done. And so one of the outcomes that you have to like respect is like, okay, we're all freaking out about the tariffs, but if individual companies, maybe the mom and pops are getting hit, but like Amazon, Walmart, and whatever are kind of like, yeah, it's a headache, but maybe no big deal yet, then I think that's another outcome here, that maybe this isn't all as damaging as what we expect it to be.
So now you're talking earnings, so I got to show you a chart.
Yeah, please do.
We've got that window opening up too for the S&P 500. I wonder if we're going to start seeing some pretty good buybacks as well. So another little wrinkle there probably in the next few days that opens up.
Yeah, this is true. So let me just show you this real quick. Now, Brent, we have this little game that we play when we do these webinars, which is Hans will talk about something and I'll go find a chart to contradict or at least argue about. So one of the things that you just mentioned was we'll find out about earnings. And this is true. At the beginning of the year, nobody was talking about a recession. There was 0% chance of it priced in. And here, then we fell down to 4,900. So the multiples got ratcheted lower, I think 19, and the earnings was like 270 and it's now 255 or something. The point is they took 5 percentage points off and fair value sits about 4,900. That's a fancy way of just saying we're not done. So Q4 2024, EPS growth was about 17%, revenue growth about 5%. And then we came into Q1, this is 2025, right? We're looking at EPS growth now closer to 10%. So they're even ratcheting down every single week, by the way. Earnings bar keeps getting lowered. Revenue growth about 4%. Anyway, this is just, by the way, again, data trek, and it's not where I get my CTA, but my point is they're really good on earnings analysis, which is why I have highlighted them. Here's the issue, right? This is actually not data trek. Forgive me. No, this is Brian Gilmartin, different source. I haven't put this on. I'm putting it together as we're talking live. Anyway, the point is Q2 S&P estimates have already started getting cut. And that reduction will likely continue for another 11 to 12 weeks. So Q2 EPS growth is expected only at 8% today. It's been reduced and it's probably going to settle out about 4 to 5%. Now, you can see how this is going. So the big question is, how far will these Q2 EPS estimates get revised lower over the next 3 to 4 weeks? That's what's going to be critical. And we already know that earnings have been ratcheted lower so the companies can beat. And the ones that are doing the sweet spot spot are getting rewarded. They're not a big tariff hit, et cetera, et cetera. You can see Netflix and Spotify. They seem to be tariff proof. I have my doubts about that. But the point is, the bigger issue is we really are going to be focused on earnings. And I think they're still going to be falling. I don't think they're safe at all. I don't think the bottom is in yet for this year by any stretch, nor do I think volatility is done going up, nor do I think credit markets are going to be frozen for long. But I also think we have structural issues plumbing from the treasury market on a confidence crisis, a sovereign bond risk to the yen. There's way too much. Why would anybody come in and buy this stuff?
Right.
Except to safely play these magnificent, explosive, headline tweets. And I keep saying that every day. Okay, we're not really moving out of this range where we fell 653 SPX points in a week. And then the next week, we made a huge bounce of about 650 SPX points. Okay, but the point is, sure, have some lotto calls or have some leaps because we're going to have these headlines. They do not want to blow up the market, but they're not doing anything to repair the market. So I'm still very bearish, obviously, but I think some of your tools, before we kind of finish out the power hour, do you want to highlight anything that you kind of point to besides your founder's note every day, which is a must read? Is there anything that you use specifically? Yes, your scanner, my team loves it.
Yeah,
anything else you want to highlight?
We just built this. This is highlighting. So you can see here, gold implied vol is very, very high. And if we're shifting more to the left on this put, it means that a chart, it means that puts are getting to be more expensive versus calls, right? So gold puts now are seemingly expensive based on this. And this is 1 month data. So if you want to express a gold long right now, selling puts may be an interesting way to do that. And then contrary to that, you see Bitcoin vol still pretty low because we're down below on that chart, but the call side is now picking up a little bit. So call skews starting to lift. So what does that mean? Well, Hans mentioned before that just because calls are starting to get elevated doesn't necessarily mean you want to sell them. If this IBIT moves all the way to the far right of this chart and we get up in this corner here, then for example, if IBIT is up here, then you're saying, okay, now it makes sense to sell calls. But right now you're seeing call skew pick up in Bitcoin, but it's not, the options still aren't that rich. So that's an interesting kind of long. And so the thing here is that the other thing I want to know is we talked about correlation before. Look at where all the other plot points are, right? Implied vol rank, which is the y-axis, so high implied vol, low implied vol, it's all in the middle, right? And for the most part, a little bit of a bid to puts, and all assets are kind of the same. So it's hard to find a differentiated trade in this environment oftentimes, but when something sticks out, it's like, okay, that's when you can grab your hammer and kind of nail it down. This is the top stocks in the US market right now. All the symbols are overlapping because correlation is basically one and everything is trading like either we're owning stocks or we're not, right? So you're constantly looking for a little bit of divergence. And the only thing that's really totally divergent at this moment seems to be kind of spiders, which tells me that if I wanted to short something right now, I would buy spider puts instead of buying, Apple or Nvidia. And a lot of this has to do with earnings kind of coming up here. These tools can really help you find the right tool, which is so important to express your view. Because maybe the cheapest thing to short the market in right now is Tesla puts because they just reported earnings and vol just got crushed there. And so if the market goes down 10%, Tesla's probably going down with it, right? And that could be the cheap put. So there's a lot of opportunity in that. And even if you find the signal is, hey, we need to short Qs, well, what is the most efficient way to put that trade on? So the scanner tool can really help you with that. And just right now, I guess the reason I bring it up is because I can still make the argument for maybe buying Bitcoin calls here. But a couple of days ago, it's let's sell gold calls. Now I'm kind of thinking let's sell gold puts because those puts seem to be picking up in value.
Super. And how about the OG?
The SpotGamma, we call it the SGOI. And again, this is a brand new model. We used to just model everything as dealers are short calls and short puts. And that's the only way we looked at the world. Now we tell you exactly where calls and puts are in various assets. So is there a stock right now, Samantha, that you're particularly dialed in on, or Hans?
The short-term gold short and only for a trade. Hans, what are you looking at? But you just went over gold, so that was covered.
Yeah, that looked.
Yeah, Google has earnings coming up, so I have them up. And so what's interesting is in all of these tech charts, right? When you look at them, if you see a positive bar here, it's positive gamma. So dealers are long those options. And so when you look down at most stocks in major Mag 7 stocks, you see dealers are long puts below. So this is kind of 140 all the way down to 120. People are selling puts in these top stocks. Now, whether you think that's right or wrong, it doesn't matter. That's just what the positioning is. And you can break this out by open interest as well if you just want to see it in a more basic format. So these bars being positive means dealers own those puts. So traders sold puts into weakness. If you look at Nvidia, we were highlighting 95 as this area, right? Nobody really owns like 75 strike puts in Nvidia. NVIDIA. Again, maybe they should, but the positioning right now shows that they just don't. Another one that's really interesting, you look at Meta. Again, all long puts down here, right? There's just not, you just don't see the single stock positioning on people betting that like Meta's business is about to go down by half. And so I got to own 300 strike puts because it's going to crash. So it's very interesting that in the single stock space, we see a lot of put selling and suggestions or implied support there. But the macro is so important now, obviously those put buyers are going to get run over if the S&P trades down 10%, right? And so it's a really interesting dichotomy right now, but I think you can use these levels where traders are selling a lot of puts as general support areas in that single stocks.
I think that's really interesting. So Brent, when you come in the morning, your morning notes are fantastic. What's sort of the first thing you do if you had to pick out like two things that you do to kind of get you kind of, acclimatized to what's going on that day?
Yeah, I think like all of us, we check futures first. And then in this environment for the last month, I go and check volatility levels. So this is what we call our fixed strike volatility dashboard. And all this is showing you is for the Qs, how did volatility change on a strike basis is the x-axis, and on the y-axis is every expiration in the future, right? So what did vols do today versus yesterday? And what you can see in the S&P, or in the Qs rather, is, when you look out a few weeks here, you can see that vols are off about half a point. Right? That's okay. It's not huge, but again, if you thought that a deal was being signed, or hey, Powell's not getting fired anymore, there's like really concrete good news, then you would expect to see volatility when you're talking, VIX at 30, you would expect to see 1 or 2 vol points decline on a one-day basis, which tells you that this is real this time. People believe that this is a fundamental change. It's good news. Like, great, I can grab onto this thing. And so I'll look at vols and compare that to the move, because in this environment, we all know the biggest rallies occurred during bear markets, right? So is this rally the real one? Well, if I see the 2% rally in fixed strike vol, in this case is down 1 to 2 points, then I go, okay, I don't really want to short this, right? This could be actual legitimate rally in this case. But when the vol is sticky, and this works to the downside too, if the market crashes 10%, but vol also drops, well, that may be a signal that the bottom is happening, right? Or the bottom is coming in because, put buyers aren't stepping up anymore. So this is the thing that I check, the most now. And you can look at skews. I just want to bring this up because I talked about how noisy the VIX is. And I just want to give a quick example of why that noise is so loud. So this is 1 month options, okay? 1 month expiration options in the S&P. So for those of you who don't know, the VIX calculation, Hans, correct me if I'm wrong on any of this, please. The VIX is priced off of SPX index options that generally expire 1 month out. There's a little bit of a range there, but 30 days is the average days to expiration.
Yeah, 23 or 26 to 36 days, something like that.
Yeah. So if the VIX goes up and down based on the price of those S&P options, okay? So this is the skew of current of 523 expiration options. If the S&P is at 4,600, this is the at the money vol, right? It's roughly a 36 for the S&P 500 because puts have a higher implied vol than calls generally, right? I think most of us know that. This is, again, what we call a skew. So if the S&P is at, let's just say 5,000, and this value here is the biggest input into the VIX, right? So in this case, let's just say it's 35%. Okay, so if the S&P rallies 400 handles because of a tweet, the biggest input into the VIX calculation is going to be these implied vols, which are essentially 30%. The VIX S&P options didn't actually change prices. It's just that the most important options to the VIX calculations changed, right? We slid down this skew curve. All that happened is we took 35% as the biggest input into the VIX and then put in 30% instead, and then you get the VIX dropping significantly. Does that make sense? So fixed strike vol didn't actually move. The implied vols in the S&P didn't actually change. It's just the VIX price change simply as a function of the fact that the S&P rallied, right? And the inputs into the VIX have a lower value, lower implied vol value. Does that make sense? Hopefully I explain that. So what you get is, hey, VIX dropped 20% today. That means that Vega or Vanna, is a major driver, and that's not always true. That's actually kind of a false positive that people will read. And so same thing, if the market goes down and the VIX jumps, everyone goes, oh, VIX is spiking, vol spiking. Well, a lot of times all that happened is we just have now a higher input because the S&P dropped. So there's a lot of noise in that VIX signal, which is why we spend so much time watching fixed strike vol now on a daily basis. I'll give you one quick comparison that'll kind of drive this home. If we add in skew from yesterday, the same date, I know sometimes I can lose people in these explanations. I got to practice them a little bit better.
No, you do great. Some people already speak this language. Some are learning and some don't care. So just keep doing you. And by the way, when you're done, go ahead.
Yeah. So what was the actual reaction yesterday, today in the volatility space, right? The gray line is the same expiration from yesterday's close, and the teal line is today's close. So you can see there actually was a little bit of a volatility decline, right? We were talking about a half a point, half a vol point, but most of what dropped was the call side. See, the spread here is bigger than the put side. So there was a little bit of a vol decline, which makes sense because Trump says he's not firing Powell anymore, and the China deal could be very good and might take a little longer. So the rhetoric did decline a little bit today. So there's not as much risk today as there was yesterday. That totally makes sense. But if there was actually a deal, then you would see the skew curve would look something like that, right? Like significantly drop. Or if everyone was buying calls, you would see that teal line go like this, right? Because when people buy calls, it pushes the implied vol up, and then you can see that reflected in options prices, and that skew would lift. So the skew is giving you the representation of the trading flow that's actually occurring around all of this news. And so there's a lot of, again, to go back to this idea of truth. And you take like an indexified number like the VIX, and it can oftentimes be off because of the fact that the market is moving 400 points up and down and really kind of bringing error rates into that VIX calculation, if that makes sense. So that's why that fixed strike vol is, of my very long-winded answer of saying, Hans, that's what I check the next thing on my day.
Your bowl of Wheaties is right here. All right. So this is how you size up the market. And for folks who are looking at the tools, one question is in Q&A, does SpotGamma include crypto assets, commodities, gold, copper?
We don't. We just look at the ETF. So I don't track commodities. And the reason is it can't get the same data in the commodity space that we get for the equity space. And quite frankly, I have an equities background, an equity derivatives background. So I understand that space. There's a lot of stuff that happens in crude oil with different players and entities and roles and things. And so our view is sort of like, I could give you the data on that, but then you're going to ask me an opinion, and I don't want to give you a bad opinion. So
that's why we have Bob. We have Bob on the trading desk, because all he does is deal with oil. That's his go-to, and he helps clients who deal with the physical. So yes, it is a very different world.
Yeah, and so our just mantra is like, if I can give you an informed opinion, I'll give it to you, and if not, I got to stay out of that sandbox because I can do more damage than warrant.
So options, equities, ETFs, indices, and already a comment in right there. Definitely amazing tools for introspecting options. That's a new one, but I love it. The fact that you have made these available and you keep building upon it. Anything else you want to say on where folks can find them, etc.? Since we have kind of gone through some macro, some intermarket, we're kind of dealing with what we get with headlines, and it's very chase oriented. Hard for some folks on a swing basis, because that's my bread and butter, honestly, to get a solid sector rotation. We were long and strong, the gold and miners, but they're definitely hitting that point where, we need to digest. Bitcoin got a little bit of that flow. Equities obviously got a bit of that flow as bonds started to stabilize. But big picture, this is going to be a long year. I don't know if we're going to have a grind, but I can definitely see a lot of volatility in waves. So you're going to be looking at that every single morning in your
Indeed,
with your Wheaties. And Hans and I will be here on Wednesday to kind of navigate what we see next for the next week. Right now, we are in a little bit of a bull bounce. The question is, how soon before it's a bull trap? And honestly, we got jobless claims tomorrow. One of these Thursdays, it's going to hit us right in the kisser because the severance pay, term kind of falls off, and then we're actually going to get numbers to start percolating higher. We're not going to get a Powell capitulation for a while. We don't even have that priced in until June, and Trump is still trying very hard to exercise strategy chaos. So for those who are more short duration, where do you find your tools, and what do you got for an offer?
Yeah, thank you so much. If you go to spotgamma.com/LaDuc, you can get a great 50% off your first month at SpotGamma. So special offer for the LaDuc community. Thank you for allowing me to present that. And we do have a whole bunch of tools for short-term traders. I see the zero DTE space. We have a ton of tracking tools, Gamma by strike in real time and different things like that, and a lot of volatility tools. And so go to spotgamma.com/LaDuc, and you can get that deal now. It's in the chat. And so thank you very much for allowing us to present that. Thank you very much for having me on today. It was really fun. And you run macro circles around me, so that's why I say that's more of your specialty, but I'll talk about you as the intermarket maven from now on, maybe.
No. I don't have a silo at all. I'm a solid generalist. I like it that way.
Don't put Samantha in a box. Got it.
That's right. Don't put baby in a box. All right. So, or in the corner. That was it. All right. I suck at idioms. All right. I wish you all a wonderful rest of the trading week. And again, Brent, thank you for being our featured special guest.
Thank you so
Hans,
much.
back in a week for Macro to Micro Options Power Hour. Thank you, everyone, so much.
Yeah, absolutely.
Awesome.
And we look forward to having you with our community as well coming up in the short term. So thank you, Samantha and Hans, again. I really appreciate it. And everybody enjoy your evening.
Thank you. Bye.
Thanks, Brent. See ya. Thanks, Samantha.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.